Not only does 1031 exchanges help real estate investors and drive the economy and basically build businesses and things because of the advantages of the 1031 exchange, but the 1031 exchange industry in and of itself is pretty substantial. Again, based on my understanding, and by eliminating that, you would be eliminating a lot of jobs. If you eliminated 1031 exchange, you're going to really halt transactions, or you're going to really dampen the amount of transactions taking place in the marketplace, because investors don't want to sell and recognize big capital gains. So they'll just hold their property potentially and just not sell. And now people aren't buying. And if there isn't as much transactions, there's not as much demand, and that could potentially stall or reduce prices. So, I mean, eliminating the 1031 exchange. And by the way, it's already been reduced so much. A 1031 exchange, you used to be able to 1031 exchange almost any capital asset. So a car, antiques, all this different stuff, equipment. The Tax Cuts and Jobs Act of 2017 passed under Donald Trump's administration. That ended up reducing the 1031 exchange to only real property, to only real estate. So they already hamstringed it down to a very small section of the tax code. Now it only applies to real property, real estate. So, I mean, I would personally be shocked if it actually was removed. And if it was removed, I think it would have a pretty big impact on the economy.
You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth.
Hello, I'm Deidre Woollard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. Today, we're going to delve into a subject that I think a lot of investors tend to dread, which is taxes. Fear of taxes and fear of difficulty in preparing taxes is something that can stop some real estate investors in their tracks and even stop them from wanting to invest in real estate. So I feel like it's really important to push beyond that and go from dreading taxes to being strategic about them and seeing the opportunity in them. And so before we get started, just a reminder, nothing in this podcast constitutes individual tax advice. Always consult your tax advisor for details on how to handle your specific situation. My guest today is someone who's made it his mission to help real estate investors understand taxes. Tom Castelli is a CPA, tax strategist, and a real estate investor himself who helps other real estate investors keep more of their hard-earned dollars in their pockets and out of the government's. He holds equity positions in several multifamily properties. He's participated in the syndication of an 82-unit apartment complex as a general partner, and his real-life real estate investing experience really helps him help his clients. So thank you for joining me today. So I know you're about to head into the busiest season. Are you finding any different concerns this year than previous years?
Going into 2021, surprisingly, no. We had a lot of crazy things in 2020 happen, or a lot of crazy questions. But going into 2021, it's still maybe the eviction moratoriums. People are a little concerned about that. From an investment perspective, there's some people who think the market's at the peak still. I mean, people have been thinking that for years, and they're a little concerned about the real estate investment market because interest rates are so low and the market is getting pushed up. The value of real estate, is that going to continue, or is there going to be some kind of fallout at some point as a result of the eviction moratoriums and all of these delayed forbearance on the loans? But that's all speculation, and many people are just moving forward and just going to roll with the punches, I guess.
So is there an additional complexity this year? You mentioned the eviction moratoriums. I know there's also investors who may have had the PPP loans or specific losses due to COVID-19. Is there any of that people need to think about as they start preparing their taxes this year?
From my experience, I work with a lot of real estate investors. That's their full-time career. So a lot of them weren't eligible for the PPP loan. Some of them were able to squeeze in an EDIL loan. But specifically for the PPP loan, something that people want to be aware of if you received one is that in the original legislation, or somewhere leading up to the most recent bill we've seen it in December, the expenses you paid with the PPP dollars were not going to be tax deductible. So in other words, that PPP income would become taxable to you. basically taxable income. But the new regulations or the new bill stated that the expenses you paid with the PPP loan are indeed tax deductible, which is very nice. But outside of that, I mean, I haven't had many interesting stories, regarding that situation. It's just, people had to lay off some workers. People had to take advantage of the PPP loans to keep their businesses going. But in terms of like interesting stories, I don't none really come to mind, unfortunately.
Do you think that we're going to have another delay in tax filings? Because I know last year there was that delay. So, do you think we're going to have an April 15th deadline? Do you feel like there might be an extension this year?
From everything I gathered, I took a look into it before hopping on the podcast here. And as far as I can tell, no, everything is business as usual this year. April 15th will be the individual deadline, with 10/15 being the extension deadline. And with entities, March 15th being the deadline, with the extension deadline being 9/15,
Hmm.
which is, business as usual. And I believe, barring any major catastrophes that may happen within the next few months, I don't foresee that changing again like last year.
Interesting. Has there been any other guidance from the government about any other changes coming out this year?
One big change at the end of the bill, and I think we'll probably get into the bill a little bit later, but going forward in 2021, business meals are 100% tax deductible, whereas they were originally only 50% for many, many years. So, I mean, that's that's the biggest thing we took away from the latest bill, the bill that was kind of pushed through towards very, very late year end in 2020. But as far as where there's not really much relief that the IRS is going to be providing in 2021 specifically.
I wonder if that will change with the new administration and we may see something that will impact 2022.
If the Democrats ultimately control the Senate, it's going to make passing tax legislation, really, I don't want to say easy, but it's going to make it a clear path for them to pass tax legislation underneath the Biden administration. That can certainly, we might see some things. I would imagine 2022, like you said, just because it's going to take some time to put together the bill, finalize it, push it through Congress, and all of that. And then ultimately, I would imagine anything that's going to go into effect would go into effect in 2022, as that's generally how it happens. But who knows? It's COVID-19's crazy times where we're living in right now, so who knows what will happen.
Yeah, exactly. So I wanted to start with talking about the K1 because I think that's one of the things that is one of the biggest hurdles for real estate investors. So can you explain what a K1 is and when an investor will receive one?
When you invest in a private placement, or private, real estate investment, generally it's going to be in the form of a partnership. Partnerships don't pay taxes at the partnership level. They will file the partnership tax return. It's called a Form 1065. That is typically due on March 15th or 3/15, unless you extend, and then you have until 9/15 to file. Now, what happens is when that return is filed, each individual partner receives a K1, and that K1 reports that partner's share of income, losses, deductions, credits, and et cetera, the rest of the activities of the partnership. And then that K1 gets reported on the individual's tax return, the Form 1040, and they pay taxes according to their individual situation. Generally, as an investor, you should expect to, depending on the sponsor who you're investing with or the investment company, you're going to typically see those right around March 15th. Some of them will get them to you. Other ones will move past, extend the return, and get them to you later. Ultimately, that will need to be filed with your tax return. So it's just a matter of communicating with your sponsor, or having them communicate with you as to when you can expect that K1.
I feel like that is something that I've heard people really complain about. A lot of people say, well, what am I supposed to do? I can't file my taxes. Do I have to file an extension? Would you say that most people who are getting a K1 have to file an extension usually just because sponsors tend to miss that deadline?
The short answer to that question is yes. I can speak from my client's experience. I can speak from my own experience. There's been multiple years. I've been investing in private placements since 2015 now, and I've had to extend my tax return almost every year. It's just part of the game. Now, what you can do is you can file your return and then go back and amend it. But generally, that's not preferred. The preferred way to do it would be to extend your return and report the K1 once it's received, and just file it like that.
Do any of the K1 providers ever miss that extension deadline entirely? And if there isn't a K1 or it never shows up, is there something else that an investor can do?
Yeah, so it's definitely been missed before. We've seen it missed. And at that point, we would generally recommend just filing your tax return and then going back and amending it later once you receive the K1. so that you're not missing your individual filing deadline, which is 10/15 or October 15th generally. So that's what we would usually recommend. As for if one never comes, that's usually a problem. That's a problem that usually means there's a problem with the partnership and you might be at risk for losing your entire investment. And at that point, you should definitely seek the advice of not only a tax professional, but an attorney, because there could be some remedies for you getting that back. But I don't want to go into it here. The process is a little bit complicated, but it is possible. It doesn't take your attorney likely working together with your CPA or tax professional to sort it all out. That happens in very, very rare cases, in my experience at least.
So, are there any disadvantages to filing late, filing an extension versus filing at the traditional deadline?
The biggest disadvantage is that your tax is going to be due at the deadline, not the extension deadline, but the original deadline, traditionally April 15th. So if you don't file your taxes, you might not know what your tax liability is. So you'll either kind of be estimating your tax liability at that point and making a payment to the IRS in the hopes that it covers whatever your taxes, your ultimate tax liability is when your return's finally finalized and filed. But other than that, there's no major disadvantage of extending outside of that.
In terms of that process, do you recommend that someone meet with their tax professional as if they were going to file at the usual April 15th deadline so they're all prepared and then just file for the extension so they have a sense of what they're getting versus waiting for that extension time and then doing it closer to that?
I would recommend engaging a CPA or a tax preparer as soon as possible. At this point in the year, they do tend to fill up, and oftentimes CPAs will work on first in, first out. So you definitely want to get on their calendars, get on their schedules, and get on their radar sooner rather than later. I would not recommend waiting until mid-year to do that. From experience being a CPA, it can get messy quickly the longer you wait. So you definitely want to be proactive, build a relationship with a CPA or tax advisor if you don't already have one now, and get on their list to prepare your return, even if you have to extend it.
Excellent. So, in terms of getting K1s, some people are investing in other states, so they may be getting K1s from different states. And I've heard that some investors are afraid of investing in different states because of those tax concerns. Can you explain what it's like to invest in multiple states and maybe why investors shouldn't be quite so worried about it?
Your state of residency, assuming your state has state income tax, which most states do. There's a handful that don't, but you're going to pay tax on your global income in your state of residence. So whatever your income is subject to your state of residence tax. What happens is though, when you own rental property out of state, you have to pay tax on that rental property in that state. What happens is that would generally lead to double taxation. However, what states do to get around that is your state of residence will generally give you a credit on your state tax return for the taxes you paid to a different state. So then you're only paying tax in one state, and so that's generally how it works. Some states have do it the other way around, and then some states have reciprocal agreements, treaties, where it's if you pay tax at that one, in the reciprocal state, you don't have to, get the credit. It's just that's the agreement they have. You pay tax in that one state, you don't have to pay tax to the other. You could look that up online, or you probably speak to your tax advisor on if how that's going to apply to your specific investments. But at the end of the day, you're usually not going to have to pay tax in two different states. That's usually what most people are concerned about, and that's not usually how it works. I guess the biggest hurdle or the biggest hassle, quote unquote, of having investments in different states is that often you'll have to file a state tax return for that state. So if you're investing in multiple private placements across various states, I mean, I've seen people having to file state tax returns in 10 states because they have investments across different states. That's the biggest hurdle, I think, when investing out of state. But most tax software and most tax professionals should be able to handle that relatively easily.
That would potentially also increase the amount of your bill with your CPA if they have to file taxes in different states, right?
Yeah. Some states have like thresholds, like the standard deduction for that state where you don't have to file if you're under it. So we'll try to take advantage of that when possible to not have to file on behalf of our clients. Other times you do want to file a state tax return because you have losses on your investment. Those losses could be used later on to offset potentially any gains you have down the line on those investments. So it depends on whether or not you do actually want to file that state tax return. I'd say by default, do you want to, if I had to give a general answer. But so the last thing I'll say on state tax returns is some sponsors, they will file a composite tax return in that state. Not all states offer this. I know like a state like South Carolina does, for example, where they'll file a composite tax return for the entire partnership with that state, so then the partners don't have to deal with filing for that state. But the downside of that is when you file a composite tax return, you're paying tax at the highest state tax rates, which may or may not be favorable to you, but it certainly makes your life easier.
Yeah, I think that's an important point that you just made about filing the state taxes even when you have a loss. I think a lot of people think if you're having a loss, maybe you don't need to do that, but you made a really important point there that if you have those losses can then be used later to offset your gains and then, limit your tax liability to some extent.
Absolutely.
One question I think that a lot of us think about is when we're preparing for that visit with the tax professional, what do we need to have ready? What should that process look like on our end? And how can we best position ourselves for the future so that it's not that year-end scramble that so many of us seem to go through?
It's a good question, and I wouldn't be a CPA if I didn't say this at least once through this interview, and that is, it all depends on your personal situation. Most tax professionals that you work with should be able to provide you a list of everything that you'll need to provide them. However, you do want to start gathering things as soon as you can. For mogul members, I would imagine K1s should be at the top of your list for the private placements you're investing in. But depending on your business or job, you're going to want to provide them the W-2 if you have a job. If you're self-employed, you may need to provide them 1099 MISC. It's an IMSC. You might need to provide them K1s for any partnerships that you have that are not real estate related. They're usually going to request any information on a home office if you have one. If you have a business, you're going to need your income statement, balance sheet, basically your financials. For retirement accounts, you might need a 1099-R, which reports any distributions or withdrawals from retirement accounts or other rollovers. If you have Social Security, you might need to provide your SSA 1099, which is Social Security benefits. I could go down the list all day. 1099 divs for any dividends you might receive, 1099 INT for any interest income, 1098s for any mortgages you may have that you paid interest on. I could keep going. I would just yeah. So for healthcare, you might need to provide them a 1095A or 1095B to report your healthcare for certain credits. You might need that 1098Es for student loans, 1098Ts for tuition, childcare expenses. Your CPA should really sit down with you, ask you questions about your situation, what you do for a living, what investments you're doing. Do you have any businesses? Do you have any children? And then that should help them determine what documentation, what information they need to request from you to do their job and file your tax return.
That is a lot. And I think that's a really good example of why you actually need to talk to someone and not try to do it yourself always, especially if you're a real estate investor, because it's not necessarily just about what you pay, but it's also about how many different credits you can get. And just listening to some of the forms that you rattled off there, you could tell that there's all of these different things that people may be missing out on or may not be aware that they can actually deduct or get credits from. So I think all of that is really vital. Paying a CPA, pays off in the long run.
Yeah, if you guys like, I have a link to a blog article that we have that has that full list that I had just mentioned. But, again, you're going to want to speak to your CPA, make sure that they're giving you a list of what they need for sure.
Absolutely. All right. So this is a great place to take a short break.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded REIT real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt. I'm here with Tom Castelli of the Real Estate CPA, and we're talking about 2020 taxes as well as what to expect in 2021. I've been hearing about some potential changes to the 1031 exchange program. So 1031 exchanges, of course, are a way that real estate investors can avoid paying capital gains as they get what's called a replacement property. And so I know 1031 exchanges are a huge tax benefit for real estate investors, especially for those who are trying to, keep laddering up into bigger and more valuable properties. Can you explain a little bit about what a 1031 exchange is and what the potential changes that are being discussed are?
Yeah, absolutely. So, 1031 exchange high level is basically what it allows you to do is it allows you to sell a property that presumably has appreciated over a period of time, and you can use the entire sales proceeds to buy another property, and you could defer the gain, so you don't pay tax on the capital gain. And if I were to give just a high level quick example off the top of my head, let's say that you bought a property for $100,000, right? And now it appreciated to $400,000 over 10 years. Let's just say you have a $300,000 capital gain. It's a little bit more complicated than that, but you have a $300,000 capital gain, and you would have to pay tax on that $300,000 capital gain. And let's just say you're paying tax at the 15% tax rate on that $300,000 capital gain. Well, now you just lost $45,000 of potential buying power. If you divide that by the loan to value ratio potentially on a property you can buy, which is usually a four times multiple. If you get it at a 75% loan to value, you just lost $180,000 in purchasing power because you had to pay taxes. The 1031 exchange has been a really good tool for investors to continually trade up, they call it, to new, bigger and better apartment buildings, office buildings, single family homes, whatever, and just continue to kick that down the road. And you can continue to use 1031 exchanges over and over and over again, essentially, in theory, until you die and never pay taxes. The challenge is if you're a limited partner in a private placement, for example, you're going to need to have your sponsor or the investment company you worked with execute that exchange, because the same entity or the same individual who basically sold the original property needs to be the same individual or entity buying the new property. And that's where the challenge comes in. You can't go and 1031 exchange your individual interest in the partnership. The entire partnership needs a 1031 exchange. So you don't see that too often. It does happen, but you don't see it too often in the private placement space. You see this with like privately held see it's like with small like partnerships or individual landlords. They'll take advantage of this. Now, as for the changes, I'm going to be candid. I'm not 100% up to date on the changes. I know there's been changes discussed. They've even considered removing it completely multiple times in the past, including, I think, this most, in the Biden plan. But the reality is, it never really made it through to changing it. The problem is because not only does the 1031, this is from my understanding of it, not only does 1031 exchanges help real estate investors and drive the economy and basically build businesses and things because of the advantages of the 1031 exchange, but the 1031 exchange industry in and of itself is pretty substantial. Again, based on my understanding, and by eliminating that, you would be eliminating a lot of jobs. And also, I mean, the more I think about it, if you eliminated 1031 exchange, you're going to really halt transactions, because, or you're going to really dampen the amount of transactions taking place in the marketplace, because investors don't want to sell and recognize big capital gains. So they'll just hold their property potentially and just not sell. And now people aren't buying. And if there isn't much transactions, there's not as much demand, and that could potentially stall or reduce prices. So, I mean, eliminating the 1031 exchange, and by the way, it's already been reduced so much. A 1031 exchange, you used to be able to 1031 exchange almost any capital asset. So a car, antiques, all this different stuff, equipment. The Tax Cuts and Jobs Act of 2017 passed under Donald Trump's administration. That ended up reducing the 1031 exchange to only real property, to only real estate. So they already hamstringed it down to a very small section of the tax code. Now it only applies to real property, real estate. So, I mean, I would personally be shocked if it actually was removed. And if it was removed, I think it would have a pretty big impact on the economy.
You made a really good point about jobs. There's, all of the qualified intermediaries. And I think that doing anything that sort of slows real estate transactions right now probably isn't a good idea. Which brings me to another program that's relatively new, which is, of course, opportunity zones. So I know that one has been. We've seen that sort of stop and start in terms of how many people have been invested and taking advantage of it. I know this year they extended the capital gains, or in 2020, they extended the capital gains deadline. There may be more changes coming with that one. Are you getting a lot of questions in your practice right now about opportunity zones and about that program in specific?
We've been getting opportunity zone questions from the time they were announced. The biggest challenges with the opportunity zones is that they really rushed that bill out, the 2017 bill, and because of that, there's a lot of guidance that was lacking. And there was like three sets, I think, or two sets of proposed regulations, and then final regulations that came out like a year and a half or so after it was released. And people are still catching up to just those. And then you had the CARES Act, which extended the deadline, basically, to your point. If the deadline, if your 180th day to defer your gains fell between, April, I think April if 2020 to the end of December 2020, you had that entire period to invest. But outside of that, I've heard whispers of potential changes to it coming, but I've not had anything concrete. And at this point, what I could say about opportunity zones is that on the investor side, if you're going to defer your gains, it's certainly a lot easier to do than if you're actually going to operate an opportunity zone. I've seen a lot of mom and pop investors, if you will, try to execute the opportunity zone strategy, and it's the compliance that you need to actually do it is usually quite expensive, to actually the legal and accounting fees that you're going to face. Good news is we see the bigger shops do this really successfully, because that's what they do. I mean, I think that's really what the opportunity zone program was geared towards, like the investment companies, the sponsors that you deal with on CrowdStreet, and you'll see through the Million Acres program. But bottom line is, mom and pop, it's, if you're a small investor, really hard to actually operate an opportunity zone fund. But if you're an investor and you have capital gains to defer, if you're investing with a quality sponsor, you should be in good hands. And there's not that much you should have to worry about, because all the regulations usually say in the regulations, if you rely on this regulation and you follow consistently, then you can go back and say, we did it based on these regulations at the time, and you'll be in good shape, if that makes any sense there.
No, it does make sense. And I think part of the reason for investing in a larger fund versus trying to do it on your own too is some of those rules around what constitutes an improvement and what constitutes, an improvement to the business. And there's a lot of rules inside the opportunity zone legislation about what actually qualifies. So I think that is a really good reason to want to work with someone who's doing a lot of this and isn't just trying to kind of wing it on their own.
Absolutely, and I think you should do that in all of your investments. If you're going to invest with a third party, you should really be setting yourself up with, someone, with a group that really has their operations built out. And that, I've been on the Mogul platform before, and I've seen the investments you have, and all of them are phenomenal. All of them are phenomenal. I'm like, oh, I should invest in some of these. But anyway, I mean, it's just, you want to always be investing with quality sponsors, whether it's an opportunity zone or a general private placement. In my experience, you want to be doing that. If you're not doing that, you want to understand the risks that you are taking by maybe investing with someone who doesn't have their company fully built out or is a little bit newer to the game of real estate.
Good point. So you mentioned earlier a little bit about the most recent stimulus bill. I know it also has some disaster tax relief in there. Is there anything else that people need to know about that stimulus bill? And what are you thinking about potentially another stimulus bill coming down the road in a couple of months?
Yeah, this latest bill, the CARES Act 2, they're calling it, that bill, not really much came through, again, on the tax side. We really dug through it, and there's, very little amount of things that changed. A lot of it had to do, there's a lot of stuff passed in that bill. Not much of it was tax related. I mean, the biggest thing I think we've taken away for most people would be that 100%. And I know I've said that a lot. It's not even that big of a deal, but that 100% business meal deduction to try to stimulate the restaurant industry. At least that's what we believe it's for. As for the CARES Act original bill, that one had a lot of big tax things. One of the major one being qualified improvement properties, basically the work done to an interior of a commercial property, like a retail or an office. And that was mistakenly under the Tax Cuts and Jobs Act considered 39-year property and depreciated over 39 years, but it really should have been 15-year property and eligible for 100% bonus depreciation that you could just depreciate all in the first year. And the CARES Act 1 bill originally fixed that. And they made it retroactive, I believe, all the way back to when the bill was originally passed. So that was a big thing for commercial investors. There's also another big thing in that original CARES Act bill, net operating loss carrybacks. So long story short, if you had a net operating loss, which means that your entire business basically wiped out your total taxable income for the year and you have a total tax loss, you were originally, before the Tax Cuts and Jobs Act in 2017, allowed to carry that back 5 years and then forward up to 20. The 2017 Tax Cuts and Jobs Act said you can no longer carry it back, you can only carry it forward. You can carry it forward indefinitely. What the CARES Act did is they said, okay, for 2018, 19, and 20, you can carry that back. If you have that NOL, you can carry it back 5 years. So a lot of real estate investors who are active, and I mean you qualify as a real estate professional. And to qualify as a real estate professional, long story short, you basically have to work in real estate almost full time. A lot of investors in droves took advantage of 100% bonus depreciation combined with these NOL carrybacks to really drive their income to below zero in those years, and carry that NOL back and get refunds from taxes paid on prior years. And I think those two things I just mentioned were the biggest changes specifically for real estate investors in the entire CARES Act legislations, both 1 and 2.
Excellent. Thank you. So I know that some of our listeners are going to be filing taxes with real estate investment trusts for the first time. We've got a lot of real estate winners members that are also listeners to this podcast. Are there any things that REIT investors need to know with REITs versus traditional stock holdings?
For the most part, REITs are similar to stocks, especially if you're investing in a retirement account. There's generally not much else you have to worry about. However, there are some nuances, though, when you are investing in taxable brokerage accounts, for example. REIT dividends can consist of three different types of three different sources. It could be ordinary income from the operations of the REIT. Ordinary income will be taxed at your ordinary income rates, up to 37%. Capital gains, which could be taxed at the 15 or 20% capital gains rates, or if it's short-term capital gains, it'll be taxed at your ordinary income rates. Or it could also be a return of capital. A return of capital is generally not going to be taxable because they're just returning the money you invested. Based on the individual REIT you're investing in, you could have different portions of those dividends bucketed into those different buckets, if you will. And then there's one more thing with REITs, which is nice. And you might be eligible to get the 20% pass-through deduction on a portion of your REIT dividends. Generally, it's going to be the ordinary income portion. So that's something that's a nice little deduction for people who invest in REITs and taxable accounts. But from a reporting perspective, to actually get down to the brass tacks of getting on your tax return, it's generally going to be reported in a 1099 div. And you can either provide that to your tax preparer or report that in the tax preparation software you're using. And, that's usually easy as keying in some numbers, or depending on the software you're using, they might be able to pull it directly from the brokerage. It just plop it into the software using their automations. But That's kind of the high level summary of REIT taxations from an investor's perspective.
Are there ever any delays with REITs reporting? Is it a situation similar to the K1s where sometimes they're a little late, or do they tend to be a little more timely?
Yeah, in my experience, they tend to be a little bit more timely. Usually when you get to the level of a REIT, you have a little bit more of a professional organization around you, or at least you should. You want to get those out, the 1099 divs out in time, and that's just my experience. I know there could be some small private REITs out there that might not get it to you on time, but generally speaking, especially with public REITs, they're going to get it to you on time.
So, as we wrap up, I wanted to get some advice from you on how people can best set themselves up, not for last year's taxes because that's already over, but in terms of like we've got a brand new year. How can people be better prepared for taxes all year long? How can they should they keep their records? Should they have them online? Should they have them in paper? Is what's the best way to kind of keep track throughout the year so that you don't end up with that end of year panic situation?
Tax return, in our view, is just a report card of the previous year's activities. So basically, it reports the income or losses of the various things you did throughout the year. And while there's a few things you can do after the year ends to reduce your taxes, it's generally going to be the things that you do, the actions that you take, the strategies that you implement throughout the year, and sometimes even years in advance that are going to impact the results of your tax return. So what I would generally suggest is that you have a conversation with your CPA, financial advisor, tax attorney, whoever acts as your financial advisor, your tax advisor, regarding your current situation and where you stand today in 2021. This is January 2021 now, and speak to them about that and what your goals and plans are for 2021. And then work on a plan with them to implement strategies that can minimize your tax liability, or just seek advice. What little things can you do to make sure you're putting yourself in a good position when that tax return finally is filed in at this point in 2022. One thing I will say is that if you're in any private placements that might be being sold this year, or any type of real estate investments really that are being sold this year, outside of maybe REITs, you want to speak to your CPA about what you can do to mitigate that. And I'll give you a quick strategy that you could use. When you sell private placements, you're going to have hopefully a capital gain. Hopefully the investment went well. And you can use passive losses that you may have had from that investment or other real estate investments, other private placements, or direct real estate investments that are generally going to be unlocked and offset that capital gain when you sell that investment. And the good news is you could find out on Form 8582 how much passive losses you have right now on your 2019 return and what you're going to have on your 2020 return once that's filed. And you could say, okay, do I have enough passive losses to offset this potential gain that I might get? And if the answer is no, and that's significant, there's a significant gap, what you could do is invest either in a direct real estate investment that you buy yourself, or invest with another sponsor, another private placement. And if they do a cost segregation study and they generate losses on that property, those losses that you receive, you'll receive that on your K1 for 2021. That K1 on 2021 will be reported in your return, and you can use those losses as well to offset your capital gain. And I'd say that's a strategy that most people, I would imagine, who are doing private placements want to look into, take advantage of.
That's probably easier to get than trying to find an opportunity zone fund to put those capital gains in.
Oh yeah, I mean, you could definitely use the opportunity zone. I'm sorry, I didn't mention that. You could use that, or you can use that strategy. It's really what's open to you. It's really, I guess, it really depends on what your objectives are. With a qualified opportunity zone, you're deferring taxes. You're deferring the tax, and you have to ultimately pay it in 2026, or if you sell the investment sooner. And then the gains on that qualified opportunity zone investment itself. So, say you invest $100,000 in deferred gains, hold it for 10 years or more, and it appreciates to $500,000. Well, now you just got $400,000 of capital gains will generally be wiped out. So the qualified opportunity zones are definitely a consideration. The strategy I just mentioned with the passive losses, that's completely wiping out your gain on that specific investment, and you no longer have to worry about that specific gain. So I think both options are very viable. I think it just depends on what your long-term goals are, and what investment opportunities are available to you at any given time. and you have to make the best decision based on those factors.
Fantastic. Thank you. Do you have time for two quick listener questions that I have?
Absolutely.
Cool. All right. So, first one is from Deb, and she purchased her home in 1996. She refinanced it a couple of times, and she asks, with a 27.5-year depreciation coming to an end, should she focus on paying off a mortgage, saving to pay more in taxes, or should she sell or move to restart the depreciation deduction?
First thing you could do is you want to look at your return on equity on the investment. Are you still earning an acceptable rate of return on that investment? After taxes, probably you want to answer that question. And if not, then you want to move to sell it and either do a 1031 exchange while you still can, assuming they actually try to remove it, or you're going to want to try to utilize another exit strategy to minimize your taxes. The other thing you could do is, if you want to keep the investment property, say it's a good investment, you're going to want to, you could buy another investment property where you might even have investment properties, and you can use the losses or force the losses through like a cost segregation study on those properties to then mitigate the taxes that you could potentially pay on the income from that property because the depreciation expense is no longer there.
Can you explain just quickly what a cost segregation study is?
So when you buy a property, there's gonna be two components. There's gonna be the building, and there's gonna be the land. The land never depreciates, but the building does. Generally, residential property 27 and a half years, and for commercial property 39 years. But when you buy the building, there's more than just the building. You have the structural components, you have the furniture, you have the equipment, you have the cabinets, you have appliances, all these various things. And the landscaping, for example. And then, so what a cost segregation study does is someone traditionally comes down to your property, an engineer, basically inspects your property is basically what happens, surveys it, and go back to their headquarters, wherever they go, and they do their analysis, and they say, okay, well, this 25% of your property or 20% of your property is going to be allocated to 5-year property, tangible personal property. Things like an appliance would be a good example of that. And then some of it might be allocated to land improvements, which is 15-year property. And land improvements, things like landscaping, maybe underground sprinklers, pools, things of that nature. And basically those two items, 5 and 15-year property, can be depreciated all in the first year, thanks to 100% bonus depreciation. So that's what a cost segregation study does. It basically takes the components of your building and breaks it down into their different class lives. And depending on the asset you're dealing with, multifamily, for example, usually anywhere between 20 to 30% of the asset's purchase price can be reallocated into these 5 and 15-year buckets. So if you were to buy $1 million property, you're getting somewhere between a $200,000 and $300,000 deduction all in that first year if you use a cost segregation study.
Awesome. Thank you. Okay, one last question. This one comes from Gustavo, and he says, I withdrew $25,000 from an IRA as I figured I have 3 years to put the money back in the account without any penalties. My intention is to invest that money in my brokerage account because it offers better opportunities than my IRA. Question is, if I hold on to those funds for 3 years and they grow inside a brokerage account and then I transfer the $25,000 back to the IRA, do I have to claim anything on taxes?
So if you put the $25,000 back in, I think it's by the end of 2022. I think that's the year, or whatever the 3-year period is. It might be 2023. I'm sorry, don't quote me on that one. But it's at the end of 3 years. As long as the money's back in the account, you're not paying taxes on the IRA investment. The way it works is you have to go back as it is today, and they might add another way to do it, but you have to go back and amend those 2 prior year returns to get the refund for the taxes you did pay on that IRA. Now, if you have to sell stocks to get that $25,000 back out, you might have capital gains. You might, depending on how those investments performed, but that's going to be taxable on your taxable account. It's not going to necessarily deal with your IRA, if that makes sense.
Yeah, that makes sense. So the original 25,000 goes back to the IRA, and then anything that's left over that is then cashed out would be taxable. Is that right?
Yeah, like if you put the $25,000 in, it appreciated to 100,000, and over the 3-year period, and now you had to sell a portion of it. Some of that potentially could be subject to capital gains tax, when that investment's sold.
That makes sense. Well, this was great. So thank you so much for your time today. And just a reminder for listeners, you can find out more about the work that Tom Castelli does at therealestatecpa.com. They put together some great classes on how investors should handle taxes and talk to their tax professionals, and they're really worth checking out.
And thank you for having me on. It was an honor.
Thank you, and stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Millionacres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.